Broadcast is now starting. All attendees are in listen-only mode.
Hi, Maya, you can begin.
Good afternoon, everyone, and welcome to this first webinar series hosted by TaxSutra along with SKP. I welcome all the TaxSutra patrons and audience who's joined on this call. Welcome, everyone, and good afternoon to everyone. We all know that BEPS Express, which began 5 years ago, has made a significant progress since its inception. Transfer pricing and transparency were among the key areas of focus point in the BEPS action plan. And in fact, BEPS action plan 13 concerning the transparency and three-tiered documentation on transfer pricing was among the first of the 15 plans which got approved by OECD. India has been a very active member of OECD BEPS project. And in fact, India was among the first few countries to also implement formal CbCR guidelines in the Indian law. With just 20 days to go for this 31st March deadline to comply with country by country reporting, filing, and master file filing, I'm sure all of you must be already in the advanced stages of completing this game-changing reporting regime. A lot of issues have been discussed since the introduction of CbCR and master file, especially balancing the transparency vis-a-vis confidentiality and so on. But on today's webinar, we do not intend to discuss these conceptual aspects and rather focus on absolute practical considerations relevant in preparing the master file and CbCR in the next 3 weeks. It would be more like in cricket analogy, a T20 cricket game. And I'm really privileged to have speakers who will, in the next 60 minutes, take us through enhanced transfer pricing documentation requirements in India. I'm joined by Maulik Doshi, who's a partner and with the transfer pricing and transactions advisory team of SKP Business Consulting LLP. I'm also joined by Renu Narvekar, who heads the global taxation at Tata Consultancy Services. A quick introduction of both Maulik and Renu. Maulik has over 15 years of experience in cross-border taxation. As I mentioned, Maulik heads the transfer pricing at SKP and also oversees the transaction advisory services team at SKP. Maulik is also a chartered accountant and he advises multinational companies and Indian groups on transfer pricing rules, planning, litigation, APA, and the transfer pricing documentation. We are also really privileged to have Renu, who heads the tax at Tata Consultancy Services, one of the large Indian multinationals, so to speak, having sort of presence in over 30-40 countries. And CbCR and master file is something which is close to her heart, and she too has been sort of spending significant amount of her time looking into this first ever documentation compliance. Very quickly, we will have Maulik and Renu both take us through certain current relevant aspects relevant to the preparation of CbCR and master file. And in terms of the outline, both Maulik and Renu will touch upon the different aspects. We primarily intend to cover the areas and the practical aspects around master file applicability to the Indian companies and foreign MNCs and the subsidiaries in India, preparation of the master file and CbCR, certain practical aspects and the procedural aspects with reference to the filing. And we also have some fantastic case studies which would be relevant to many of you who are attending this call today. So Maulik, over to you. You are our opening batsman for today's T20 game. Maulik.
Thank you, Amaya. Thanks everyone for joining in for this webinar. Like Amaya mentioned, we kind of very broadly going to cover the master file and country by country report, some practical aspects. So I'm presuming everyone will kind of have worked on this assignment till now and would have kind of gone to the basics. So I'm not going to cover the basics in detail, but just very quickly in terms of just to take everyone on the same page. The Action Plan 13 advocated a three-layer transfer pricing documentation. the country by country report, the master file, and the local country file. We were used to the local country file till now, which was the part of the Indian regulations under 92D and Rule 10D. The country by country report and the master file are the new documentation requirements that the companies to whom they are applicable would come into picture. The country by country report, as everyone is aware, is applicable for only companies with global consolidated turnover of more than 750 million euros. So it's only very large companies that get attracted to this requirement. The master file is more like a blueprint of the entire business group. Like it's the CEO's story in terms of how business is conducted across the group, and that's actually been prepared at a group level, at the ultimate parent company level. The headquarter would generally prepare this and make it available to all the group entities for it to be filed in the local country jurisdiction. Uh, as of now, the world has kind of gone about and almost it's not an India specific thing. So almost a lot of countries in the world have implemented these new requirements. More than 63 countries have implemented the country by country report. 6 countries are still under the draft stage, and there are another 13 that kind of have intentions to implement. Same way, master file, more than 33 countries have implemented. Obviously, everyone would have different thresholds and different criteria to for it to make the master file applicable to its taxpayers. But a lot of countries are moving in the direction where both master file and country by country report are kind of being made a part of the local statute, and companies operating in these jurisdictions would have to comply with this 3-tier transfer pricing documentation. So, as such, this is one phenomena where we say India is not taking a unilateral action, but it's kind of a coherent thing across the globe where all the countries are coming together to create the new transfer pricing documentation requirement. The CbCR, as I mentioned, the threshold is 750 million euros or 5,500 crores in Indian rupees term. It provides a very quick and a very broad overview in one Excel sheet in terms of the group key financial information in terms of the sales revenue, the profitability, the number of employees, the intangibles, etc. So that's idea is to for the tax officer to at one go is able to look at what all information is there. From an Indian perspective, the country by country report will kick in only when there is an Indian ultimate parent company that is preparing the country by country report, or the group company has designated the Indian company to be the subordinate entity to prepare the country by country report. Else, otherwise, where the group has prepared the country by country report and there exists some exchange of information agreement between India and the other country, the Indian company would have just to intimate the Indian tax officers some details where the country by country report is prepared. So for foreign companies operating in India, the CbCR is more of a compliance exercise, especially with countries where there is already an exchange of information available. For Indian parent companies, it's a new task, it's a new requirement where the Indian parent company would have to prepare this country by country report and file it with the Indian tax authorities in India, and then it would be exchanged under the automatic exchange of information by the Indian tax authorities with the other countries where the Indian company has presence. On the master file side, most of the countries, especially European countries, have kept the threshold of master file same as country by country report, which is 750 million euros. But India has adopted a very low threshold. It's roughly 65 million euros or 500 crores in terms of Indian rupees. So any company or which has a group consolidated turnover of more than 500 crores and the intercompany transactions of more than 50 crores in terms of the tangible trade transactions, or more than 10 crores if there are intangible transactions. If both these criteria are fulfilled, then the taxpayer would have to prepare and submit the master file with the Indian tax authorities. So unlike the local TP documentation, which generally we prepare and submit it only when the tax officers call for it, the master file is a very important aspect that this needs to be submitted through online mechanism before 31st March 2018. So the due date for 16-17 financial year is 31st March 2018, and due dates for the subsequent financial year would be 30th November, the date of filing the tax return. So this master file, as I mentioned earlier, is like a CEO's report card on the business in terms of what are the key entities of the group, how the supply chain works, how the intangibles are distributed, how the financial position of the company is in terms of where the finances are being raised, what are the important profit drivers. So it kind of gives a kind of a bird eye view of how the group conducts its business all across the world. So in that sense, it's a very important and a very critical document, and the tax officers would want to look at the master file to gain a much more insight in terms of the in terms of how the group is operating. Very quickly, while OECD did prescribe the master file requirement under its Action Plan 13, India has also prescribed what it requires in form of master file. And there are some differences between the what the OECD has prescribed and what India is kind of expecting in terms of master file. One of the most important differences is in terms of the function. The OECD provides that the FAR analysis has to be there for the key entities within the group, whereas the Indian requirement is that FAR entity has to be there. FAR analysis has to be there for entities which contribute 10% in terms of group revenue, assets, or profits. So that's one of the major differences. We have come across clients and cases where the FAR requirement as per India, in the sense that there will be group entities which exceeds the 10% requirement, and therefore there is a detailed FAR required to be put in the Indian master file. But the group at a group level, that FAR is not existent, so the company has to do and kind of perform the FAR analysis right now. So that's one of the most important requirement. Another major change is in terms of intangibles. The Indian regulations requires that all entities in the group who are engaged in development and management of intangibles to be listed along with their addresses. There's no such requirement under the OECD master file framework. So there are some of these kind of differences between the OECD framework and the Indian framework, and therefore everyone has to be extremely careful in cases where the master file is prepared at a group level to whether to file it immediately or to kind of look at it from an Indian perspective, wherever required, customize it, the Indian requirements, put down the Indian details onto it, and then file it with the Indian tax authorities.
Maulik, thanks for laying this framework. Renu, let me quickly bring you in over here very on preparation of both master file and CbCR on a very, very practical level, getting the information from different operating entities and so on. Any one or two experiences that you would like to share very quickly before we look at some of the interesting case studies and issues?
Yeah. So thank you, Amey. Thank you, Maulik, and good afternoon, everyone. Yeah, I think BEPS has been something which is keeping us awake for a long, long time. And if I talk in respect of TCS, where we operate in more than 50 odd countries, it has been a challenging but an interesting experience trying to gather the data, trying to understand what the business policies have been. There have been certain subsidiaries or branches which have not been, if I may say so, given the requisite kind of attention, because obviously transfer pricing was not applicable in those jurisdictions. But I think BEPS has changed all of that. So yes, there have been challenges. Also, I think just wanted to add in terms of a few more intricacies in terms of the master file and the CbCR requirements. There was also this requirement of every entity filing a notification, some jurisdictions, as to identifying who the ultimate parent is. So that was an additional requirement, and I think the dates were all across the place, all over the place. So you practically had to maintain a calendar to ensure those deadlines were met. And because this was a new requirement, trying to understand what the local requirement was, in some jurisdictions it had to be done in the local language. So trying to get that translated and meeting the timelines, again, it was challenging, but like I said, it's been an interesting experience. I think one other challenge we have is in the CbCR, there's this main business activity that you're supposed to report. One, the fields have been pre-populated, so there's only so much you can sort of tick the box in terms of what the main business activity is. There is no clear definition of what is a main business activity. So should it be 50% of my revenue? Should it be the number of transactions? I think there's lack of clarity on that front as well. So yeah, these are the few of the challenges, if I may say, that we've encountered in terms of the data collation.
Right. And very quickly, 30-second answer. Any particular country where the experience has not been all that smooth, or any group of countries, out of the 50 plus countries that you see where CbCR and master file exercise has been particularly very tough?
If I can say, I think it's LATAM and your Africa.
Perfect. Thanks, Renu. Maulik, moving on, as I mentioned in the beginning, we will now look at some of the practical aspects. And the first aspect is on the threshold, that is basically the applicability of master file preparation itself. We saw sort of two levels of threshold, 500 crore and a 50 crore threshold. And Maulik, would be great if you could take us through some of the interesting scenarios and your views on them as well.
So I have kind of put down a couple of case studies that we encountered, and these are just the two of them. But the applicability of master file itself is the biggest question in terms of a lot of clients are grappling with whether master file, the entire part A and part B is applicable to them or not. So this is a classic case where there is an Indian entity which has normal trade transactions with its foreign subsidiary. The trade transactions are below 50 crores. Apart from the trade transactions, the way Indian definition of international transaction is, it includes likes of loans, guarantees, and even kind of accounts receivables. There have been kind of issues in the past, and most of the companies were started disclosing accounts receivables from associated enterprises as a separate transaction in Form 3 CEB. Now the question comes is what happens to these transactions when you are calculating thresholds over here. So if your intercompany transactions, the main trade transactions are below 50 crores, but if your non-trade transactions, if I may say, likes of accounts receivable or the absolute amount of loans or absolute amount of guarantees, if you put them together and that exceeds 50 crores, whether master file is applicable, both part A and part B are applicable or not. So this is a kind of a interesting scenario. And strictly speaking, if you look at the definition of applicability of master file, it just talks about the value of international transaction. Which talks about all the transactions put together. And if it's exceed 50 crores, one needs to kind of report, or one needs to kind of prepare a master file both in terms of part A and part B. So going by a very strict and literal interpretation, both even in the scenario like this where the intercompany transactions are less than 50 crores, but something when you add up accounts receivables or loans, it exceeds 50 crores, master file would have to be prepared both for part A and part B. But like everyone was expecting that the CBDT would come out with FAQs and provide clarifications for such kind of transaction. It does make a case for such transactions to be excluded from the purview of master file, because in spirit the actual value of intercompany transaction is less than 50 crores and does not serve any purpose either for the taxpayer or for the tax administration to go into the details of such kind of cases. But as of now, we still have not received any clarifications, and therefore most people are kind of would be taking a conservative view and complying with the master file requirements. The other case that I wanted to kind of deal with is that there's an Indian company which has subsidiaries in India, subsidiaries abroad. Apart from the subsidiaries, there are a couple of entities which are more like associated enterprises, and these entities are associated enterprises by virtue of the deeming fiction as provided under the associated enterprise definition. So as everyone is aware, the associated enterprise definition is quite wide and even includes entities where there is no direct control in terms of shareholding. But if my majority of purchases, 90% of my raw material purchases is from a particular entity, or if one of the entities is controlled by my relative, all those cases will fall under the associated enterprise definition under 92A2. So those cases, in this scenario also, what happens is if you put together the transactions with subsidiary companies only, it is less than 50 crores. But if you include the transactions with associated enterprise, which are like more deemed associated enterprise, then the value would cross 50 crores. And in these cases also, the question is whether kind of master file applies or not. It's one important point to note here is that the associated enterprises, which are not my subsidiaries, they don't get consolidated with me. They are kind of independent entities as such from a control, capital, and consolidation perspective, and therefore the results are independent. Uh, but yet, if you again go by the definition which is there, the definition talks about the aggregate value of international transactions, and since transactions with associated enterprises also would fall under that, once the transaction with subsidiaries and associated enterprises crosses the 50 crores, the company would have no option but to comply with the master file requirements. But the important point over here would be what would happen to the requirement or the details in respect of associated enterprises, whether such details would have to be disclosed in the master file. Again, as a company in India where I don't have a control over the associated enterprise completely, I may not have all the information that is required from a master file perspective, and therefore it will be very difficult practically to provide those details in the master file. There the view is that according to me, the master file is to be maintained for the international group as a whole. The international group as such is not accounting for these associated enterprises because they are not consolidated with the international group, and therefore information in respect of such associated enterprises need not be maintained in the master file and need not be kind of put across. So we'll come across this interesting cases time and again where the applicability itself of master file is a question mark. And Renu, if you can kind of share your experience, if you have come across something like this, it would be great.
Yeah, so just adding on to Maulik, I think here again is a very clear example of discrepancies between the OECD and the requirements as per the Indian income tax. So as per the OECD, for the CbCR purpose, what they call, all you need to report is transactions with related parties, and they refer to a constituent entity, which is a subsidiary which gets consolidated under line by line. So if my AEs are not getting consolidated as per OECD, typically I don't need to cover them in the master file. However, as for the Indian requirements, like Maulik rightly said, they refer to international transactions. So my transactions with the AE will also get caught under the master file requirements under the Indian Income Tax Act. So there is a discrepancy on that, and whether to report that in the master file or not is a debatable question. Second is, even if I do disclose this in the master file, how does it impact my CbCR? Because to me, master file and CbCR go hand in hand. While one gives a qualitative description, the other gives a quantitative description. So if I do incorporate the transactions with the AE in the master file, will I then necessarily need to incorporate it into CbCR? So again, it's a question mark.
Absolutely, Renu. You hit the nail in terms of including those in CbCR, because many times we have seen that even companies don't have access to the financial information of associated enterprises. They're just deemed to be associated as per law, and they don't get the requisite information. So even if I include in the master file, what happens is an open question.
Renu, quick question, Amey here. Have you seen any other country where the threshold for master file applicability is broader than India's threshold?
No. I think India has gone to a very different extreme altogether. Not only in terms of the threshold, but in terms of the requirements, I think it's much more exhaustive than I've seen in any of the other jurisdictions.
Right. And Maulik, very quickly, have you seen any other country where the deadline for filing of the master file is already over? As in, is it before 31st March, which is in India, and to that extent, all the Indian headquartered multinational companies, it would have been relevant for them to know. Any country that comes to your mind?
A lot of European countries did introduce master file from January 2016, and for them the deadline was 31st December 2017. So those deadlines were just kind of over last year, just 3 months back. So there are these countries where the deadlines were over before India also.
Right. Before we move on, a small announcement for all the attendees on this webinar. At the end, we will have some time to take few questions from you. We've already received questions from attendees. We will take some of them, but in case you would like to add any additional question to any of our panelists, please type your questions in the console which is available in front of your screen. Moving on, Maulik, master file applicability to the foreign companies and their Indian subsidiaries. I think there are a lot of interesting aspects to be covered over there as well. Maulik?
Right. As far as foreign companies operating in India through Indian subsidiaries, for the Indian subsidiaries, the thresholds are very well defined and the clarity is there. But we see there's so many instances where foreign companies are filing tax returns in India on a gross basis. They may not have a permanent establishment in India also. Especially companies receiving royalties, technical services fees from the Indian companies, and in those cases, the foreign company files a tax return. In those cases also, where the thresholds are exceeded. So, if the consolidated group turnover is more than 500 crores, and the intercompany transactions, so the value of royalty or technical services fee is more than 10 crores or 50 crores. In those cases also, the question is whether a foreign company would have to file Part A and Part B in terms of the master file. So Form 3CAA, whether a foreign company would have to file that form or not. And here also, purely based on the Indian regulations and the way regulations are worded, it includes every person being a constituent entity of the international group. So it does not make an exception to foreign company, or it does not tie down this requirement to a company resident in India itself. So to that extent, even foreign companies who are having intercompany transactions with the Indian subsidiaries and foreign companies filing tax returns in India, for them definitely they will have to comply with the master file requirements. The question is, for foreign companies who are not filing tax returns in India, who do not have a permanent account number in India, whether they will have to comply with master file, and if yes, would they have to kind of procure permanent account number specifically for this purpose? That's slightly kind of stretched from a practicality perspective. I think if the foreign companies are till date not filing a tax return in India, and if they do not have a permanent account number, they may kind of want to take a practical position in terms of how to file whether to file a master file or not. There's another interesting bit in terms of for foreign companies who are having transactions with the Indian company. Generally, we classify them as taxable transactions, which are likes of royalty, technical services, etc., and non-taxable transactions in terms of sale of goods, which generally are not taxed in India. So, question is for determining the 50 crore limit, whether both taxable, non-taxable transactions has to be determined, only taxable transactions have to be determined. So these are all the questions which are still open. Again, no clarification from CBDT. I think given that this is the first year of activity of master file, it would have been a really good step if CBDT would clarify this something by way of FAQs. We have seen number of CBDT has come out with FAQs, so this was one place which I thought was absolutely required in terms of clarifying the positions. It's unnecessary compliance for the foreign companies, because in any case the master file requirement has been filed by the Indian subsidiary. So it's to the extent a duplication of work, duplication of compliance also. So if there is a positive clarification on that line saying that the foreign company did not comply with, given the fact that Indian company has complied with it, I think that would be really, really helpful from CBDT side.
Renu, I know we are dealing with the inbound situations over here and not really outbound. Any comment before we move on to the master file preparation?
No, just one in terms of taxable or not taxable. I don't think there is any. The way my interpretation right now is all international transactions need to be disclosed. So whether it's taxable or not is not a criteria. So for example, even dividend. So dividend received is not a taxable transaction, right? But because it's an international transaction, ideally it should be disclosed. So that's, but I agree that there is no clarity in terms of whether the non-taxable, whether they are trying to give a breakup of taxable and non-taxable. According to me, they want to see the group's performance, the group's business models, the group's activities, and therefore my interpretation would be that all transactions, all international transactions, whether taxable or non-taxable, need to be disclosed.
Right. Renu, thank you for that comment. Maulik, after the threshold of master file applicability, I think the preparation of the file itself, there are some interesting scenarios. So, if you could move on to cover some of those aspects around master file preparation, please.
Yeah, so essentially some of the scenarios, especially that deal with foreign companies operating in India, like Renu mentioned earlier, and we covered, the threshold for Indian master file requirement is 500 crores, which is extremely low. Most of the other countries have adopted thresholds which is the OECD threshold of 750 million euros. So we have come across scenarios where at a group level, say the headquarter company is based in France or in UK, where the threshold is 750 million euros, and for them the master file is not applicable because they are below the threshold. But due to the Indian requirement of 500 crores, they are crossing that threshold, and therefore the master file becomes applicable from an Indian perspective. Now, the scenario is that the Indian company has to request the group for the master file, and the group come back saying that we have not maintained this because it's not applicable to us in our own country. And only for India purposes would the group have to kind of go ahead and make a master file, prepare a master file, and then provide it to the Indian tax authorities and file it here in India. So we come across a number of scenarios where suddenly the group has been taken aback by these thresholds. And if you recollect, while the regulations came in in terms of introducing the budget of 2016, the actual notification and detailed rules came in only in October. The threshold of 500 crores was kind of there only in October, and it came as a big surprise to these multinationals because they have not done any groundwork or any preparation work, given that they were very far off from the OECD threshold. But suddenly, because of the Indian requirement, they were able to file master file in India and start preparing. And if I can say it on a little bit side note, a lot of group companies have kind of just said that it's not possible for us to prepare. If India wants to take the initiative and prepare that, let it prepare, coordinate with all other countries and prepare that. Because suddenly the new requirement comes in there and they don't have any time to kind of comply with that. And same is the case with in terms of the details of master file. So where the functional analysis has to be prepared. Like I mentioned, the Indian master file covers a scenario where all entities of the group which are contributing to 10% of the revenue, profits, or assets. So it's either or. It's not that end scenario. So if any of the entity contributes to either of this factor at a group consolidated level and exceeds the 10% threshold, the detailed file of that entity would have to be kind of maintained in the master file and file it with the Indian tax authorities. So the OECD model prescribes for key entities, and there are scenarios where some of the entities do cross the threshold but may not be regarded as key entities from a group perspective. And even in those cases, kind of the file analysis would have to be done. And a lot of countries may or may not have maintained local transparency documentation. There may not be a requirement. A lot of African countries are kind of coming out with the documentation requirement recently. A lot of countries don't have any compulsory transfer pricing documentation. So in all those instances, there's the one has to start fresh and start doing the FAR analysis. And generally, again, we've seen on the FAR analysis side, they are kind of prepared on a one-sided basis. So generally, you have the details of functions, assets, and risk from only for one associated enterprises rather than a two-sided analysis. And therefore, this kind of intricacies would come in when one starts preparing the master file. And we have still not kind of gone ahead and looked at how the filing would happen, because once you go onto the department software to file, the experiences with GST were definitely not favorable. So here also there are so many restrictions in terms of the number of words and number of characters to be used. while filing an online master file requirement. I still kind of wonder why government wanted this online filing of master file. We receive master files in Word and PDF copies from the group companies. There's an additional effort to kind of just adapt it to the Indian requirement, put it across on the income tax utility, and then get it converted into XML and file. Easier way would be just to file a PDF or a scanned copy of that, but I don't know. The requirement is right now to file an online copy with so many restrictions in terms of the number of words and characters to be used.
Right. So, Maulik, a very quick practical question. So, are you sort of preparing a short, abridged summary just to make sure that all the important points are covered over there? And would you suggest that once the notice subsequently comes up, like for the tax return, you would file the detailed master file at a subsequent stage? What's the practical advice and what is it that a company should be doing in this case?
I go back to my school days where I used to do a lot of pressy writing. I think that's what we are doing it nowadays. Yes, the practical call would be we have no option but to summarize the key aspects in the limits that the online utility has, and then keep the master file with us. And if there's a question from the tax authority, submit the entire master file.
Right, Renu, any take on this from an Indian point of view, or if you've done a similar compliance in any other country elsewhere?
Yeah, so I think in terms of the FAR requirements, I mean, if the TP documentation, like I alluded to earlier, if the TP documentation was not done earlier for whatever reasons, or the law in that respective country did not require us to do, I think we don't have a choice now. There's no option but to do the documentation in the jurisdiction. So for example, Africa, if it was not done earlier, not needed earlier, there is no escape now. So we will have to do the TP documentation globally. And obviously, we cannot have a one-sided FAR. So, for example, one entity says that I'm not a risk taker. The risk is borne by my counterpart in the US. And if I look at the US FAR says, oh, we don't take risks. So, at the end of the day, which is the entity taking the risk? So, the FAR has to be sort of mirrored in the other entity. So from a practical experience, we as TCS, like I said, given that we operate in 50 odd countries, it will be very high risk for us to do separate FARs. So the position that we're taking, we're doing one consolidated FAR rather than doing a consolidated, rather than doing a country specific FAR. So that's the practical position that we have adopted. And coming to the filing formalities, it's going to be a big challenge because it's not just the number of words, because I was just seeing the nature of business, you have to bring it down to 1,000 words. The important value drivers, which is the main crux of this whole BEPS exercise, is not more than 1,000 words. I'm not sure, even if I was good at pressy writing, and I can speaking for myself, I think tax professionals, we are used to long submissions, lengthy appeals. So I think pressy writing itself is a challenge. But to condense into 1,000 words, and especially if I have an ultimate parent, which is into, say, diverse lines of businesses. So if I have a cement and I have a motors and I have a IT company, I don't know how they're going to consolidate all this and bring it down to 1,000 words. So it's not just bringing it down to 1,000 words, it's consolidating the master file across my business lines and then trying to make some sense into those 1,000 words.
Right, very interesting, Renu. Maulik, thanks for those insights. And even CbCR preparation, isn't any short of surprises, Maulik?
CbCR, well, what happened? The major element of kind of bone of contention right now on CbCR is for the US headquartered companies. India has still not signed the automatic exchange of information for CbCR with USA. So if that's not in place by 31st of March 2018, it means that every US headquartered company where CbCR thresholds are crossed, the Indian counterpart would have to actually file the CbCR with the Indian government here. So that's one of the major worry aspects. And time and again, when we have been talking to tax officials, we have been told that, yeah, it's on the verge of signing. The earlier thought process was it would be in place by mid-February. But we are kind of almost on the closing days and we still don't have any CbCR exchange of information with US. Obviously, there are other countries, but US is major because that's the major trading partner and we have a significant amount of FDI investments from US. Same way in terms of when you are actually putting in the details in the CbCR, specifying the main business and activity of the group, like Renu mentioned, it is to be kind of selective from based on the number of words and based on some of the descriptions and number of employees. It becomes very difficult to sometimes classify these things into the CbCR report. And Renu, if I am sure you would have kind of come across scenarios where these details would have to be kind of put down. So maybe you can share your experience in terms of how CbCR is kind of prepared right now.
Yeah. So I think the biggest challenge that we faced in CbCR was getting the employee data, because given in the services sector and given in the IT sector, employee mobility is a big is very, very prevalent for us. So we have employees on deputation, we have employees on short-term business travel, on general business travel. We have a number of what we call business associates. So what is it that we sort of disclose in the CbCR? Do we disclose it on an average basis? Do we disclose it on a yearly basis? Because if we do it on a yearly basis, it's going to reflect a clear picture, given the fact that employee mobility is so high that people actually move on a daily basis. So I think that's been a biggest challenge. Two is, if I get the employee data and somebody tries to reconcile with my payroll data, it will never reconcile, because there's a payroll cutoff date, and the mobility, there's no cutoff date for obvious reasons. I mean, people keep moving. So I think getting that data has been very challenging, and in terms of having to substantiate that data has been very challenging. Also, the fact is, like I said, we have number of business associates. So should that be considered in the number of employees, or should that be excluded in the number of employees? So that there was a lot of debate before we finally decided that it's probably better to include, because the way this is going to work, I'm sure the authorities are looking at running several ratios on this data. And if, for example, you show the huge revenue in one jurisdiction, but you show less employees because most of your employees are BAs, then it will not give them the right ratio that they would look for, and it will call for more scrutiny. So I think that's been one challenge. I think the other challenge that I see with CbCR is, though they now say that whatever data goes into the CbCR does not necessarily need to be reconciled to the financial accounts, which is fine as of today. But I mean, it's fine as long as you have your parent company on an IND-AS, and we can sort of post data from the IND-AS financial accounts. But if somebody, say in France, wants to reconcile or look at the parent CbCR, and they try to reconcile it to a local French GAAP, it will never tally. So I think that's going to be another challenge.
Absolutely, I agree with Renu. We receive the notices from transfer pricing officers, and the first question in generally the notices is that please reconcile your AS18 disclosures with your Form 3CB. So if the tax authorities start reconciling the financials and the CbCR report, it's going to be a nightmare for Indian companies. So,
right. Maulik, as we talked about the impact of CbCR on different aspects of the overall transfer pricing policy, you know, on the slide you already have 6 balloons and six areas to be touched upon, but would be great if you could take us through this slide and also link it up with what companies need to do in the remaining 3 weeks that they are preparing the enhanced transparency documentation. Maulik?
Right. So the most important aspect in kind of for the master file would be now to align the master file that the group has prepared with the India requirements. I think most places, companies and people are facing the challenges. Small details like the Indian master file requires name and addresses, whereas a group master file would never have an address mentioned in the master file. So even these small details, people are kind of at the last moment would have to kind of scurry about and do find out those details and put it in the master file requirement. So essence is that if there is a group master file in place, start reconciling with the Indian requirements and have please start customizing the master file to the Indian requirements which are there. Migration from the old way you maintain the documentation, which is basically the local country file. That is the only visibility that you had. You didn't have any visibility at the group level. So migration from the old requirement of transfer pricing documentation to the new requirement would also be a very important task. And most importantly, I see kind of when things are coming onto the fore, and the whole purpose of the entire action plan 13 is transparency, and therefore when details and facts are coming on in form of either master file or country by country report, there are other areas that are getting kind of exposed, and kind of one needs to kind of also consider those areas, like whether there is a permanent establishment exposure, whether there are withholding taxes being properly deducted, whether there are any anti-abuse provisions or tax treaty benefits being properly taken. So all these questions start coming for when a lot of these details come to the fore, and therefore not only in terms of preparing the master file one and the country by country report, one has to be kind of careful, but even look at the other areas which are there. And there's been a lot of uncertainty, a lot of questions that are there in terms of what if I put this detail in the master file, how is the tax authority going to think through it, what is the tax authority going to be further questioning me. So all of those things kind of be prepared at the time, being prepared at the time what comes at the time of audit. All these things are kind of extremely important to be considered right now. So I know we are in a rush, and kind of we need to file these in next 20 days. But if we overlook some of these aspects, it's to be kind of it's going to be a death knell, and the tax officers are going to kind of scrutinize that very heavily. Any you have any points?
Right.
Sorry.
No, I was going to toss it on to Renu. Renu, any quick comments on any of the aspects over here?
Yeah, I think just to add on to what Maulik said, I think one major issue is the interpretation of the data by the tax authorities, because like I said, the master file and the CbCR put together gives the qualitative and the quantitative information about the company. And this data, if different authorities across the world are going to look at it, I'm sure everybody is going to interpret it differently. And what's going to be really worse is if one tries to interpret it and try to make us change, make an organization change their pricing policy, because many organizations, they follow global transfer pricing policies. And if I have to tweak my policy for one jurisdiction because the interpretation is different, it will probably change my entire TP policy. So I think that is one big risk. And I think the other main risk is the data confidentiality, because this is again going to be in public domain to a certain extent. And I think a lot of things, the way we operate business, the value drivers, I mean, there is every possible chance of leakage of data. So I see that as a major risk.
Maulik?
Right. So I think confidentiality is definitely one important aspect, and while the top level tax officials have kind of assured time and again at different forums that confidentiality would be maintained and there will be no passing of information, etc. Yet there is some apprehension around those side. What I'm going to kind of now may I discuss about is some of the issues that we are facing across, and some of the questions that would come from the tax authorities. You prepare the master file, you prepare the country by country report, it's all filed with the tax authorities. But some of the aspects that we came across while doing a few client cases, one is typically in case of small and mid-sized groups. So larger groups definitely have more definitive transfer pricing policies in place. There are the transfer pricing manuals and all those stuff. But small and mid-sized group, which are kind of in the growth stage, they have set up operations abroad. The operations may be in 3-4 countries, not very significantly large. Those kind of groups are kind of grappling with 2 or 3 very important aspects. Generally, these groups, the way they behave would be that the Indian company would participate very heavily into the affairs management and all other aspects of the overseas subsidiaries. It's a very small group, so in a sense, it's quite integrated. So if the overseas groups require some quick help on HR, or it requires some strategic directions, the Indian board and the Indian key management persons would be kind of always there to ensure that the overseas companies get that requisite information, help. For them, it's all one businesses, so the idea is to how can they further their business in the overseas country. For this kind of companies, generally we find that they don't have any management fee policy or a intangible policy in place. And I am sure there will be questions coming on from the tax authorities saying that, okay, if your key management people are lying in India, they are sitting in India and they are supporting the overseas operations, is there a management fee charge out from the Indian company to the foreign subsidiaries? Is there an intangible charge out from the Indian company? If the overseas companies are using your own brand, they are maybe using the same name as the Indian company. Is there a specific charge out for management fee or royalty for the use of trademarks? So those kind of questions would come up from the Indian tax authorities perspective, and one needs to be kind of extremely careful right now while preparing the master file itself to see how one will anticipate those questions and prepare for it. The management fee questions, again, one needs to kind of look at and see what activities the Indian company is doing on behalf of the foreign subsidiaries, and whether they get classified under the shareholders activity, stewardship activity, or it actually requires a management fee charge on account of that. So one needs to be kind of very really aware of these facts and really look at that in a very hard manner right now while preparing the master file.
Right, Renu, any comments on charge for these transactions, granting of loan, guarantee, or intangibles also for that matter?
I think on the management charge, you should look at it. If I was to get this service from a third party, what would be the charge out? I think most probably it's basically for the administrative, technical, and financial or commercial services that the parent provides to the subsidiary. But we need to have a very clear intercompany services agreement in place. The charge out should be on a fully loaded cost, and obviously this should be documented. So I think that is very relevant. The point that earlier there was no management fee is not going to hold water in the current scenario. So I think that will definitely call for a change. In terms of granting loans and guarantee, I think as far as the financial guarantee is concerned, I think there's a very clear-cut guidance now that there has to be a charge. You cannot have a financial guarantee without a markup. But in terms of a performance guarantee, I think the issue is still debatable. But again, it makes sense to have a policy documenting whatever you're doing, whether you're charging, you're not charging. Basically, you need to have a story for whatever you do. So if you're charging, what is the basis for the charging? What is the benchmarking for the charging? If you're not charging, then obviously the substantiation for not charging that charge.
Right.
So same way, I mean, another case study that you kind of come across, where again the parent entity is based in India. There was subsidiary in Dubai, which is kind of more of a trading entity. So the sale of goods in the Russian, the CIS, and the other region takes place through the Dubai entity, and the parent entity in India would kind of sell the goods to the Dubai entity, which would further kind of sell it to the distributor in the distributor associated enterprise in Russia for the local selling. And they also have a manufacturing entity in Indonesia, which is kind of more recently set up. And in the normal course of business, the Indian entity has allowed the Indonesian company to use the brand know-how and kind of have not developed any royalty charge out or a licensing policy as of now. So again, these cases are where the overseas expansion has just happened in the last 2 or 3 years, and the companies are still grappling with in terms of the businesses being put out in those respective countries, and have overlooked the transfer pricing or the tax aspects. And again, it would be kind of when you're preparing the master file right now, all these things will come to the fore, will be highlighted. The question is whether Dubai entity, what kind of functions they're actually doing to deserve any remuneration. Are there any people? Are they doing kind of any really marketing or distribution activity? And same way, what would be the rationale for allowing the Indonesian entity to kind of charge to use the brand name know-how without any specific charge? So again, this kind of cases would prop up and would be examined by the tax authorities quite closely. You have any thoughts over in terms of, have you come across anything on a similar line where purely based on master file requirements, people have revisited their transfer pricing policies and started putting down the transfer pricing policies in place?
Renu, you have any comment on this point before we move on to the next one?
No, not really. I completely agree. I mean, if I look at this particular structure, I mean, if the parent company is selling products to whatever the Dubai entity at low margin and without much value addition, if it's selling at a higher margin, it just looks to me to be a distributor, which should be on a cost plus basis. So again, yes, when you're doing the documentation or drafting the master file, this has to be, I mean, the FAR analysis has to be very, very clearly brought out.
Amaya, I think
Right.
we are closing on to our close time of webinar. So what I'm going to do is skip the next case study and just go on to the closing comments in terms of what are the next action plans for kind of companies. Is that all right?
Yeah, Maulik, in fact, if possible, if you could take a few questions before moving on to this closing action points, so that we can address some of the practical aspects of preparation of the CbCR. And while you look at the questions that are in front of you in your console, we've got few questions before, and let me put forward first question, and maybe Renu or you could answer it. So the question is, in case of the Indian wholly owned subsidiary of a UK parent, where the wholly owned subsidiary is just a dormant company with no revenue activity for financial year 16-17, whether 3CEAA and 3CEAC filing is required to be done. Maulik, your thoughts on this?
I think the requirement would be there to file in this case because the fact that the entity is dormant, etc., does not make a difference. The regulations are very clear that they provide for such kind of so they provide for compliance even in those cases. So I don't see a way out in terms of this kind of filings to be done.
Right. Renu, we have another question, and Maulik, maybe you can take question thereafter from the console. Renu, the question is, what is the purpose of master file in case of outbound India entity? That's what the question reads. Presumably, the question is more for the Indian parent, which was anyway earlier submitting the TP documentation. So the question is now, what is the purpose of master file in case of outbound India entity? Any thoughts, Renu?
Yeah, I think this whole exercise is about bringing about more transparency, and therefore, while I agree the Indian parent was doing the TP documentation, the master file sort of brings a holistic view of the group. So it's not just about what was happening in India, but what was happening as a. So the way I look at it, I always say between the master file and the CbCR is the kundli of a company. And I don't think that was ever in the preview of the tax authorities. They probably had limited access to what was happening in India. And yes, if you had subsidiaries or branches across the globe, depending on the jurisdiction you were operating in, those were subject to audit. But what this is bringing about is bringing about a complete transparency to the group's operations. So whether it is your business model, it is your transfer pricing model, it is your organization structure, it's your intangibles, I think it's the entire story about the group. So I think there is merit in the master file because it does give them access to information which was not previously with the tax authorities.
Right, absolutely. Maulik, any other questions from our audience here?
There is one question I think for you, Amaya. The question is, is there any chance of the master file deadline being extended beyond 31st March 2018?
No, I don't have any update. And the moment we have, we'll put out a breaking news on Tax Sutra.
So there are other questions also, and I'll take them one by one. There's another question which says that the accounting year of the international group is from July 2015 to June 2016. The utility form in 3CEAA is not accepting a date prior to 1st January 2016. So the question is what to be done in those cases. Yeah, the problem is right. The utility does not accept a date before 1st January 2016. So in those cases, the only practical aspect is to write 1st July 2016 to 30th June 2017. It goes beyond the Indian financial year, but I don't see any other way out except for writing those years. There is another question which has provided that what is the penalty for not filing the master file by 31st March 2018? The penalty that they have prescribed is 500,000 Indian rupees, 5 lakhs under the Indian regulation. So if the master file has not filed by that date, it will be the penalty would be 5 lakh rupees. In country by country report, if there's a delay in filing, there are penalties which are linked to the number of days of delay, and there's a per day delay penalties. But for the master file, they've kept it simplistic in terms of a straight penalty of 5 lakh rupees. There's another question I think which we have addressed during the course of our webinar, that if a non-resident company file its return with an income of more than 50 crores, will it be required to file master file in India? It would be required to file a master file if the intercompany transactions are more than 50 crores, not the return of not the income criteria, but if the total value of transactions with the Indian associated enterprise is more than 50 crores, it would be required to be filed the master file in India. I'm just going through the other questions. So there are.
Sure, Renu, there is another question till Maulik looks at the remaining question. The question that we have received is, what if the Indian operation is less than 1% of the group? Then how group level information in master file would be relevant to the Indian tax authorities for assessment? In other words, how best to put forward master file in the context? While the question is in the inbound scenario, I'm sure it would be relevant in an outbound scenario as well in some of the countries where, let's say, the value of operations is very small. Renu?
Yeah, but I don't see a way out of this, because irrespective of the value of the business, I think the master file requirement will still remain there. So whether it is 1% or 10%, I mean, I don't see how the Indian regulations will allow you not to be filing a master file, because there's no exception.
Right.
The threshold limit is for the group as a whole. So I don't see a way out of that.
On a very similar line, Samaya, we have a question which says that the Indian entity turnover is only 1 crore and the consolidated group turnover is 10,000 crores, and the parent entity in US has prepared the master file and CbCR. And so should the Indian entity also file Form 3C EAD or only Form 3C EAC informing the alternate reporting? I think for the time being, only Form 3C EAC, with the hope that India and US does enter into and does sign off the automatic exchange of information. If that doesn't happen, then the Indian entity would have to file the CbCR that is prepared overseas and file it with the Indian tax authorities. I think
right.
Those are the questions. There are a couple of questions which are repetitive. I think we have covered them in our presentation. So I am not going through those questions.
Sure. Sure, Maulik. I think it would be good to have closing comments from Maulik, you on the action plan, and Renu, of course, some quick comments from you on some of the key priority areas for you in the next 3 weeks.
Right. So
Maulik.
Yeah, action plan is start working. A lot of time anyways has elapsed in terms of actually there was a lot of time gap in terms of the actual provision that came into picture and the rules that came into the final rules that came in, but now people would have to kind of start putting down the details. I think as we move forward, right now everyone is in a kind of a firefighting mode. We are preparing the master file and CbCR for the immediate requirement, but there needs to be a kind of a defined system for real-time and periodic monitoring of this data and gathering of the data, so that the subsequent years compliances become much more easier. Obviously, one needs to kind of understand and see how these details are being collated at a group level, what kind of group level details are available, what are not available, and wherever there are gaps, try and kind of fill up those gaps. It's very important to make a good interpretation of the group-wide data that is collated and see if there are no kind of red flags or there are no areas which can be caught by the tax authorities. If one can anticipate what all questions the tax officers are going to ask, kind of do an what if analysis for the potential questions. That would be really good. And one needs to be kind of giving a very harmonized picture between the country by country report, the master file, and the local country documentation, and kind of see how the data and the details that are presented are much more integrated. Renu?
So, Aman, from our perspective, I think we are good to go in terms of the preparation of master file in CbCR, and this is predominantly because we started this a year ago. We did dry runs, we formed steering committees, we had a lot of data challenges, but we did a lot of sensitivity around the data. So I think we're in good shape. We've done a ratio analysis, we've run several ratios, we know what the outliers are, we know what the red flags are. So in terms of work to do, we have analyzed what it is. We obviously can't change what is given. So we have to build a story, a business case or a story around what is there. But it sort of helps us to look into the future and see where we need to focus going forward. In terms of the major activities in the next 3 weeks, we have to share the data with our ultimate parent. And the challenge is going to be, like I mentioned earlier, the consolidation of the data and trying to upload this data within the number of words that is required.
Right. So that brings us to the end of this very, very fascinating session on country by country reporting and master file enhanced documentation requirement. Maulik, thank you so much for sharing your expert incisive analysis on number of issues. And Renu, extremely grateful for joining this webinar at a short notice and also sharing a lot of practical tidbits, insights around the strategy for preparation of this important compliance. On behalf of TaxSutra and SKP, we thank all the attendees who joined from across India to listen to this webinar. Do write to us with your feedback, and if there are any more questions as well, we're happy to sort of take them offline. Thank you so much, everyone, and wishing everyone a great weekend ahead. Thank you.
Thank you.
Thank you. Thank you.